Hi students, so this lecture for BBA second sem on corporate accounting first. In last class we saw related the valuation of the shares, and one of that method, which is the valuation based on rate of earnings, we solved problem on that, how to calculate the value of shares, or as well as how to calculate the expected rate of earnings, how to calculate, okay, all these things with the problem, with the help of the problem we understand this problem on that. And now in this session we will start next B method, which is the valuation based on price earning ratio. Okay, so now see, under this valuation based on price earning ratio, it means what, this the value of share is ascertained by taking consideration two factors, namely earning per share and price earning ratio. Okay, so in this valuation based on price earning ratio, it means what's the earning per shares. We have to ascertain what's the earning per shares. The earning per share means what, suppose if the company is or business company or the business is earning yearly rupees 10,000, and there are 5,000 shares are there. Okay, 5,000 shares are there. It means what, for the each shares out of this 10,000, how many they are getting or how many they are earning. So like this we have to ascertain. Okay, so this is the earning per shares. Okay, so we have to calculate this, as well as the earning price earning ratio we have to calculate, and as well as the market value of shares we have to ascertain under this valuation based on price earning ratio. Okay, so now these are the formulas for the earning per shares is equal to profit available to equity shareholders divided by number of equity shares. Okay, as well as the price earning ratio, market value of shares divided by earning per shares for this price earning ratio, and the market value of shares is equal to earning per shares into price earning shares. This is the formula for this. Okay, so these are the formulas are there. So with the help of these formulas we have to calculate the value of shares under the valuation based on price earning ratio. Okay, so now see, this is the problem. Following is the capital structure of Amok Company Limited. Okay, the capital structure is given here of the Amok Company Limited. So see, 12,500 equity shares of rupees 10 each, it's 1,25,000. Okay, so 20,000, 10% preference shares of rupees 10 each, it's 2 lakh. Next, reserve and surplus, it's 1 lakh. Okay, next it's the reserve and other liabilities, 10% other liabilities, it includes 10% debentures, it's 1,12,500, as well as 12% term loan, it's a 60,500. Okay, so the average annual profit before payment of income tax and interest on debentures and term loan is rupees 93,750. The rate of income tax is 30%, and the applicable price earning ratio is what's 9. Okay, so this is the actually this is the what's this is the with this information we have to calculate the value per shares. Okay, so now see the A, which is that the 12,500 equity shares, these are the equity shares, and the each share price is rupees 10. So this 12,500 into 10, it's a 1,25,000, and this 20,000 shares are there, which are shares preference shares. Okay, and so this rupees 10 each. Okay, so 20,000 into 10, it's rupees 2 lakh. Okay, and so this 10% is nothing but what's the interest of the dividend. Okay, it is the dividend percentage of the dividend. This 10% we have to calculate on this rupees 2 lakh. This is the 2 lakh, it's the capital, no? Okay, so on this 2 lakh we have to calculate this 10%. Next, reserve and surplus is the 1 lakh, and the other liabilities is the 10% debentures. This 10% is nothing but the interest to pay to the debenture holders. Okay, so this 10% we have to calculate on this 1,12,500. Okay, so this 12% term loan, the term loan means what's the loans taken from the financial institutions. Okay, at the rate of 12%. Okay, so this 12% we have to to pay on the 60,500. Okay, now first of all we have to calculate the profit available to equity shareholders. Now how to calculate the profit? The profit is given here 93,750 before paying the income tax, before paying the interest rate, before paying the what's debentures interest. Okay, so all these things we have to minus. Okay, now see one by one how to minus this. First of all you have to take the 93,000, calculation of profit available to equity shareholders. Profit for the year before interest and tax, it's a 93,750. From this, in 93,750 you have to first of all minus the interest. Okay, so debentures interest as well as the terms interest. Okay, so less interest on debentures and term loans. So interest on debentures, it's a 10% of this 1,02,500 is the 11,250. Okay, and interest on loan, it's a 12% on this 60,500, it's a 7,500. Okay, the total is what's 18,750. So this 18,750, it is the interest on debentures and the term loan. You have to minus from this 93,750. its remaining amount is rupees 75,000. So this 75,000 is nothing but the profit in bracket before income tax. So this is the profit whatever they got. From this profit you have to minus the income tax. Okay, so less income tax, it's a 30% on this 75,000. Okay, so 30% is nothing but the 22,500. so this 22,500 minus from this 75,000, remaining amount is what's 52,500. so this 52,500 is nothing but the profit. Okay, in bracket after tax. Okay, after income tax. So after this income tax you have to pay what's the dividend. So dividend on preference shares or 1,000, sorry, here is by mistake, it's a 10% of rupees 2 lakh. Okay, so it's a 20,000. So this 20,000 you have to minus from this 50,500, remaining amount will be the 32,500. Okay, so it's 32,500 is nothing but the profit available to equity shareholders. Okay, so now put into the formula calculation of the earning per shares. So earning per share is equal to profit available, and the profit available is what's 32,500, and the number of equity shares here is there in the number of equity shares in the problem A, 12,500. so this 12,500, these are the equity shares. Okay, so 32,500 divided by 12,500 is equal to what's 2.60. Okay, and the value of shares, how to calculate? Earning per shares into price earning ratio. Okay, into price earning ratio. So earning per shares is what's 2.60 into price earning ratio is what's 9, the rupees 23.40. Okay, so this is the value of a shares. Like this we have to calculate. Okay, so in the earlier class we saw that the valuation based on price earning is nothing but what's, or you can say it's the capitalization factors. Okay, so now see this capitalization factor. So this is an alternative method of valuation of shares to price earning ratio method. Okay, so for this which for B, valuation based on price earning ratio, no, for this purpose with alternative method is there, and which is that alternative method? It is the capitalization factor. Okay, so now see this is an alternative method of valuation of shares to price earning ratio method. Capitalization factor is multiplier for determining the capitalization factor. Okay, and 100 should be divided by normal rate of return for the calculation of the capitalization factor. Okay, so now see how many, it means how many formulas are there. So these are the following formulas are there for the capitalization factor. 100 divided by normal rate of return, this is the formula for this capitalization factor. And for this value of a business, so value of a business is equal to profit for the year into capitalization factor. Okay, profit for the year into capitalization factor. And now how to calculate the value of business? Value of a business in divided by number of equity shares. Okay, so these are the formulas. Now one small simple example we will see for this capitalization factor. From illustration, see this. From the following information, compute the value of an equity shares by using application factor. Okay, so profit earned by the company is rupees 25,000. Normal rate of return it's 8%, and the 10,000 equity shares of rupees 10 each is rupees 1 lakh. Okay, so this is the problem. So now see this capitalization factor. So formula is above, formula is there, 100 divided by normal rate of return, and the 100 as it is we have to take, and the normal rate of return you are given in the problem, it's 8. Okay, 100 divided by 8 is what's 12.5 percentage. Okay, so now calculate the calculation of value of business. The value of business is equal to profit, and the profit is given in the problem is rupees what's rupees 25,000, and capitalization factor we ascertain it's a 12.5. okay, so 25,000 into 12.5, it's rupees 3,12,500. okay, so it is the value of business. Now put into formula for the calculation of the value of shares. okay, so value of business is rupees 3,12,500 divided by number of equity shares. Here is given in the number of equity shares is the 10,000, so rupees 31.25. okay, so we got the value of a share. okay, like this we have to calculate the value of shares under the capitalization factor also. okay, so just try to understand this problem and just solve it. okay, and might be your internal exams will be conducted on, it means we are going doing planning to take the internals on 8th 9th 10th. so please all of you do the study seriously. okay, and whatever I took the ppts I will share with you, and just find out the answers, it means find out the meanings of that. okay, and just note down in your notebook, and just all of you make it the fair book. it means whatever I solve the problem, so you have to what you have to write in your notebook. okay, so thank you.